The Tradex Bond Fund has grown nicely over the last year, and largely due to your contributions and confidence and trust in our management. We certainly appreciate that. My name is Mark Klinko, and Steve and I will share the presentation. There's a shorter list of slides than last year. We understand that bonds aren't as exciting as stocks, and so for that reason we try not to put people to sleep. But at the same time, we did want to share with you some of the objectives and goals, and we'll look at the first slide. As background for some of you that may be new to the fund, the objective really is to generate a higher income than the DEX bond universe, your benchmark, combined with the potential for modest capital appreciation. Now, if you think of the world of investing, of course, if you have higher expected return, what runs with that is higher expected risk. So, of course, to generate a higher income normally would require higher risk than bonds alone. But your portfolio, importantly, has lower risk than a traditional full stock portfolio because we have bonds, corporate and government bonds, as well as preferred shares to complement that. So ultimately, as you see, what we're doing is we're combining different asset classes to provide risk diversification and a higher yield. On page 2, or slide 2, I just wanted to highlight some of the asset classes that are a little unique to your fund, and that is those asset classes that perhaps aren't in most bond funds. In particular, the first one you'll see is preferred shares. These are investments that have a higher yield than bonds, typically by about 2% on an annualized basis. In our view, provide good quality that are tax efficient for those of you that have a taxable account, but importantly have lower risk or lower volatility than a conventional common stock. The downside, of course, as you'll see with the X there, is they don't provide inflation protection. So what we do in the Tradex Bond Fund to provide that is to add these higher yield common equities on the right-hand side, income trusts and real estate investment trusts. And as you'll see, importantly, if you look at the price volatility and risk line, you'll see that we can mitigate this added income or yield through industry and issuer diversification. And I think the final thing really to highlight on this page, of course, is the inflation protection. And that's what these common stocks offer. As inflation grows and corporate earnings grow, you're participating in that element of the business success. So let's look at the next slide, performance. Of course, this is probably what you've all come to see and hear. You'll see we have 3 lines in the top chart. First off is the gross performance of the Tradex Bond Fund, and we show 4 different time series. For those of you that are new to this fund, we became your manager exactly 2 years ago, ending March, so we have a full 2-year track record. For those of you that have been with us for the last year, you'll see under 1 year a total return of 6.7% versus the DEX Universe Bond Index at 4.5%. Importantly, that difference is what we call the value add. So that's how much better you've done by investing in the Tradex Bond Fund rather than investing, for example, in the index. At the bottom, we just wanted to give you a sense for yields. Of course, yields are part of your total return. And what you'll see here is that as of the end of the first quarter, your bond fund was yielding 3.5% versus the index at 2.2%. So therein lies one of the advantages of your fund. That, in addition, that difference of about 1.3%, in addition to whatever capital appreciation we can generate for you, contributes to your total return. On page 4, just to give you a bit of a sense of how we've done in terms of those underlying asset classes, it's of course well and good to say we've beaten your index, but we've done it pretty consistently across all of the asset classes that are built into the Tradex Bond Fund. What you'll see on page 4, really the key takeaways are first, each asset class that we've been managing for you has outperformed your benchmark or the DEX index. So that's really key. But secondarily, as you look at these 3, each asset class has outperformed its own individual benchmark. So, for example, if you look at preferred shares in the middle of the chart, the benchmark we're using is the Bank of Montreal Capital Markets 50, which comprises 50 different issues of preferred shares. You'll see that over the last 2 years, ending March, we've been able to generate a total return of 10.1% for you compared to that index of 6.0%. So that's a pretty positive value add in our view. And below that, in terms of higher yield common equities, which are the type that are included in your portfolio, here over the last 2 years, an annualized total return of 10.1%. And of course, that's 10.1% for each of those 2 years versus negative 2.2% for the S&P. That's the Canadian Stock Index. So really, page 4 is to say that these are the constituents or components behind your aggregate return within the Tradex bond fund that have allowed us to outperform for you. On page 5, just before I turn it over to Steve, wanted to highlight for you the asset mix. As you sort of can garner by now, we obviously have a different mix than the DEX Universe Index, your benchmark, and of course that really is by design. We're intending to be different to add value. Maybe if we look at the right-hand side of the chart here, if you look at the beige bars, you'll see the DEX Universe Index. The first bar are the Government of Canada or Government of Canada equivalent bonds at 41%. To the right of that, corporate bonds, followed by provincials and municipals. So that gives you a sense of what makes up the index. To the left of that is your fund, and as you see, it's very different. We have a little bit of cash at 1.3%. We have about 72.5% in bonds, and that would include government bonds, which government bonds are federal government bonds, provincial and municipal, as well as corporate bonds. But the real distinction here is, as you'll see, is 9.4% allocation to preferred shares and almost 17% allocation to common shares, income trusts, and REITs. And really, those last 2 asset classes are distinctly designed to augment or enhance your yield. So at this point, I'll turn it over to Steve. Steve Copeland is chair of the investment committee at Foyston, Gordon & Payne. He's also the portfolio manager for the FGP Income Fund, and most importantly, he's a portfolio manager for the Tradex Bond Fund. So I'll let Steve speak to the final couple of pages, pages 6 and 7, just to give you a sense of our outlook and direction going forward.
Well, thanks, Mark. If you see me here and with Mark next year, you know the fund's doing well. If Mark shows up by himself, you know things aren't going very well. But, the fund actually has been set up really not to shoot the lights out and earn 8 or 10%. It's to earn a better return than bonds and be less volatile. So we've got a combination. Theoretically, the thing, if bonds are going up, stocks are going down. If stocks are going up, bonds are going down. Sometimes that works, sometimes it doesn't. But over a long period of time, we're trying to at least earn that 3.5% in the fund right now. We've obviously done better than that because the stocks have done well. Bonds have also done well, so that there's sort of been the perfect storm of great returns from both bonds and stocks, which isn't the normal course of business. But we're really trying to just maintain a decent rate of return, which will beat bonds over time. The central banks of the world obviously have helped us out. Everyone, as you know, what they call, as you see, QE, that's an infinity sign. It's sort of a crooked infinity sign, but that stands for quantitative easing, and that's basically the central banks of the world, starting with the US, buying bonds, injecting money into the system, hoping that that money at very low interest rates will help people to borrow, spend, corporations to buy capital equipment, and the economy to get going. It's not working so well right now. I mean, right now all that money's going into stocks, but it's not really going into lower unemployment rates. It hasn't been going into substantially higher economic growth. On top of that, we've seen further entrance into that let's buy the bonds of the world. The Bank of Japan recently, over the last 3 or 4 months, has decided that they're going to do 3 times as much as they've ever done, 3 times as much as the US has done in terms of buying bonds, buying stocks, to try to get the economy going, to prevent inflation from falling rather than rising. They want inflation to go up because they feel that will help things. And it has really helped stabilize the capital markets, the stock and bond markets of the world. There's obviously a lot of threats, as you can see. Last year we talked about a lot of threats from Southern Europe. That continues. There's always another blow-up happening, whether it's Cyprus and people seizing funds, but that will continue on. But we really see a world where there's a lot of slower growth, but not negative growth. Next slide. So what we're trying to do is, in the bond portfolio, eventually that money, if the economy were to start to really improve, if we're getting 3 or 4% growth, we may see a lot of inflation. And that, bonds basically hate inflation because your coupon is fixed, and loaves of bread at $1, $2, $3 a loaf go to $5 a loaf. That coupon doesn't buy as much in the future. So bonds hate inflation. We don't have that problem in the short term. But at the same time, if interest rates do rise, some of the higher yielding stocks may struggle as well, because they may not have the earnings in that environment to continue to generate the total rate of return that you've seen in your portfolio. But interest rates are extremely low. If you have a 10-year Government of Canada bond is 1.7%. Inflation is 1%. The center of the government in Ottawa here takes, at the margin, 40 to 50% of your money. You really aren't getting anything after tax, after inflation, whether it's an RSP when you take your money out. So you're really trying to reach a little bit for yield, but to do it in a somewhat secure environment that you're buying companies that do, common stocks that do generate higher yields, but we want to buy those companies that can continue to pay that dividend, not cut the dividend, in a very slow growth environment. So we have a lot of conservative names in your portfolio. We're not trying, as I said, we're not trying to earn 10 or 15 or 20% a year. We're trying to grind out that type of return that will help your portfolio grow slowly over time. And it's going to be, it's a slow growth environment. But if you're earning 3.5% or 4% a year over a period of 5 or 10 years, it can really help you improve your retirement or your after-tax income over time.